Hi, everybody. Garrett Baldwin. Welcome to a very special edition of State of the Republic. I hope that everyone is doing very well. It has been a while since I have been on air, at least a year from doing day-to-day work from my departure from Money Map Press. And as a lot of you know, that I did move to Maryland back in May. I've been here for a couple of months, and it's been a little bit dull. I'll be very, very candid with you. I kind of feel like I was brought up here to sit on a bench for a little while, give other people my ideas. And I've just kind of gotten to this point where I said, you know what? I'm tired of doing this. So what I'm going to do is I'm going to get up and I'm going to start swinging the bat a little bit more. And I'll say to everybody, you want to chat after this conversation? Please do. I am your number 3 or 4 hitter for the next 10 years, and I am ready and eager to get to work. Now, as you know, for those of you who don't know me, I did have a very nice studio when I was down in Florida at my former house, sold that house, moved up here to Maryland, and now I kind of have this thing down here. Quietest room in the house is in the basement, and you don't need a lot of stuff. You just need an American flag, some good baseball cards, Elvis, and, of course, Moneyball. All right, so the point of today, this very special conversation that we're having today, I'm going to be talking to you about my worldview. I am giving this away. I am not doing anything except explaining to you in the next 45 minutes how we think about the markets. I'm not selling you anything. I'm not asking you to purchase anything. I am giving this away. I'm going to do a little bit on my background, our expertise, my investment upside ideas. I'm going to talk about our alternative worldview and on 3 major trends. These is liquidity, momentum, and insider buying. And this is about exploiting the financial systems designed. And then what I'm going to do after that, I'm going to give you the number 1 stock to trade based on what you cannot unsee. And that is the theme of today, the things you can't unsee. And we're also just going to give away 10 other tickers that are tied to this pick. Now, if you don't know me, my name is Garrett Baldwin. I am an economist. I've worked in finance. I have been doing a lot of things for 20 years. And today's presentation is the summation of all of that work. And I'll explain to you why I'm doing that in a moment. Now, my primary focuses are on 4 things. First is on the macro side, monetary policy. I have a master's degree in economic security from Johns Hopkins University in Washington, D.C. I worked with Ellie Kennedy, who is the head of the Western Hemisphere of the World Bank, who is very influential in my understanding of how monetary policy operated when I first learned and understood how the system worked. I also studied a little bit at Harvard in the summer of 2018, focusing on global liquidity and cross-border flow under Dr. Reinhardt. In addition, a micro with an MBA, a lot of focus on company catalyst, value drivers, the things that really employ the success of a company. What are the 5 or 6 things that really drive customer value and drive shareholder value? This is one of the things that I gave away in my report on enterprise product partners, just talking about the things that make the company successful. So when you see a headline that is tied to any of these things, you know that that is a potential catalyst for greater shareholder value in the future. I am a trained energy, agriculture, and commodity economist. I've done a lot of supply chain work globally. My primary focus is in the midstream of energy and in the downstream of agriculture. And we also focus on anomalies with a big, heavy focus on insider buying and reversion momentum. And we're going to talk about both of those things momentarily. Why give away all of this today? Well, there's a couple of reasons. Something happened in the last week that really upset me. A friend of mine had worked on a project for about a year and a half, and he went everywhere and pitched this idea. And it was a phenomenal idea, And I was going to work on what was a concept that I was developing while he was working on his own idea, which was this kind of Anthony Bourdain of finance. That's what I've wanted to do. When I got up here, that was what I was excited to do, to go shoot these shows, to go actually build the Republic out. And he didn't get anywhere, and I couldn't get anywhere, and I've kind of been on the sidelines. And then unfortunately, somebody copied his idea this week. And I'm not happy about it. And I know he's not happy about it, but I'm going to lay out all of my worldview. I'm going to give it away today so that you know on September 15th that the three things that you're about to see are a summation of all of the academic and financial research that I have done since 2008. This is everything. I'm not selling you anything. This is free. I am tired of the media narrative. I went to Northwestern. I was a journalism major there. I know a lot of people in financial media, and I just don't think they get it. They don't see how the system works. And in my view, this is not that complicated. I've been on the sideline for 12 years. I've been helping a lot of other people. And in my industry, I've had a lot of people just say, give me your ideas, Garrett. And then they go and they do very, very well. And then I'm kind of sitting around going, wait a minute, where's the distribution on this one? So it doesn't matter to me. Are you a fund? Are you in private capital? Are you a family office? Are you in the publishing industry? Call me. Send me an email, because once you see what I'm going to show you, you are not going to unsee it. And a lot of people say to me, well, I don't know how to sell this. Okay, well, I'll give it away. And then once you see it, you're going to go, well, I don't want to do all that work. Why don't I just call Garrett, or why don't I email Garrett, or why don't I read what Garrett's writing? Because that's the thing that I focus on. This is very macro, but it is also very purpose driven. And at the same time as we look at this, I love to challenge narratives. When I was studying at Hopkins, I did some work in a class by Ellie Kennedy at World Bank. And the first thing that he made us learn was effectively good old fashioned market hypothesis, the efficiency of the markets, Malkiel's random walk down Wall Street. Everybody has to read it. He made us learn CAPM. Don't do that to yourself. And all of us took the test and we didn't do well. And then he turns around and he says, doesn't work anyway. The markets are driven by fear and greed. They're driven by behaviors. And the entire concept of that example, when he tore up our tests and then made us learn and read things like Richard Thaler and actually understand that, yeah, it really isn't just about cash flows. Yes, it's just not really about what the Fed is doing at any given moment. Well, that was so critical to me that I thought to myself, well, wait a minute, what else don't I understand? Or what else are people being told that might be wrong? So these are the things that I think about, right? Do valuations matter? Is PE ratio that important? Does more information lead to better decision-making? That's a myth. Are the markets actually random? Are they so random that market timing is impossible? Are markets efficient? Is debt that dangerous? Do earnings and rate policy really drive markets? And the accepted narratives are not absolute. It is more no than yes, and therefore wrong. Now, as you said, I was a little bit upset about my friend losing a big idea. So we're going to do this. We're going to cite everybody. Everyone that I have read and influenced me is getting credited today. Everyone. And we're going to start at the top, which is Michael Howe and Capital Wars. And this book is on my desk, and I read his blog very often at Substack, and it is worth every dollar. It's $75 a month. The next thing that's highlighted is multiple discriminant analysis on price momentum anomaly and reversal event signals by JD Henning. JD is over at Seeking Alpha. JD is one of the most influential academics in all of finance, and he has done an absolutely incredible job at shaping the way that people should perceive market timing. And a lot of my academic work, as he was finishing his PhD in 2016, I was finishing my MBA with a lot of focus in insider buying and market anomalies under Dr. Carreau at Indiana. I got my hands on this thesis a few years ago. He sells it for $20. And if you have the time to read 300 pages, it's worth your while, because what he has figured out, and we're going to lay it out in this presentation just a little bit. I'm not going to go too deep into it because it is his work. Now, his father is Grant Henning, who wrote Trading Stocks by the Numbers, Financial Engineering for Profit. Great layout in four primary technical indicators that people can use, because those four are linked together. There's 25 different things that you can trade upon: fundamentals, technicals, big macro ideas. These four things have very strong synergy between them to make momentum trading work. Great book that Tim Melvin had given me in 2014, Dual Momentum Investing, an Innovative Strategy for Higher Returns with Lower Risk, by Gary Antonacci. is one of the best momentum workbooks that there are in the world. And then finally, I would be remiss if I do not give a lot of credit up front to Tim Melvin. He is my father-in-law. I have known him since 2011. We do Thanksgiving dinner every single year, and the conversations that we have about the markets are effectively legendary. It's funny, a friend of mine from college and I talked the other day. We hadn't spoken in about 15 years, and he and I had a conversation. He runs a family office, and we started talking. We had an hour together, and we talked about private capital and BDCs and illiquid assets for an hour, and we never got a chance to even say hello, and really start talking about like what we've been up to and what our kids are doing and how many things have changed. And at the end of it, he said, well, we have to do this again. And I said, yeah, absolutely. He said, I don't get to talk to anybody about all of these different investments. People have no idea what I'm talking about. So I have to thank Tim, because I feel like sometimes Tim and I are the only people who can speak one another's language when it comes to some of the things that we discuss. So all of that is out up front, okay? All of my work is cited today. All of this is free. And I ask you just to stick around. Again, we're going to talk about that number one ticker, and we're going to talk about our worldview here at Republic Research. Now, my focus is to get you to think differently, and we are going to put an emphasis on three major factors that you cannot unsee. So pick a sector and pick a card, and your card today, of all things, in tech, all this communication, all those momentum stocks. Now, the only card you need to pick today is the insurance industry. And I'm going to show you how we pull this thing from the bottom of the deck. Now, before we begin, I want you to keep your hands and feet inside this ride, and I want you to remember the number one rule of systems. This is Engineering 101. A system is set up to create the results it achieves. This is attributed to W. Edwards Deming. A system is set up to create the results it achieves. So whatever the results are, the system is designed to do that. Every result reveals the true design. And today we're going to reveal the true design of the financial system itself. So we're going to start with the first pillar of this, three-legged stool. We're going to give a toast to what is called global liquidity. This is measured by Michael Howe, cross-border capital. Again, Substack. I'm going to show a couple of his charts, and I just want to point out that this is one of the big things that was the narrative shift that I was looking for. I was trying to understand how it was possible that the S&P 500 would rally the way it did from 2023 to 2024 with interest rates elevated, with all this chatter about the Federal Reserve lowering its balance sheet, that somehow the equity markets would continue to be driven into the stratosphere to new highs. And the way that he is measuring global liquidity, and you're going to see this in a chart in a moment, is every dollar, all cash and credit in the financial system influencing asset prices and global economic activity. This is all the money that's created by shadow banks like hedge funds and venture capital and BDCs and all of the alternatives out there, but it also includes regional bank balance sheets. It includes corporate balance sheets. It includes household balance sheets. And once again, Howe measures this on a weekly basis. These are the global liquidity cycles of boom and bust in the dollar system, in the global financial system, in the fiat system post-1971. And this chart is from Ainsley Wealth. I believe they're over in Australia. And as you can see, they are simply looking at the global liquidity index data from cross-border capital. Now let's focus over here, because my focus is post-2008. I think the whole system effectively evaporated in 2008. I think capitalism died in 2008, and I think we have been on life support ever since. And all we continue to see is a significant boom and bust number of cycles in liquidity. So just start from the great financial crisis that transpired in 2008, and then you saw that Q1 boom that happened 2009. From March 2009, took the market higher. We ultimately sink into a Eurozone crisis. First assignment today. Remember this date. Write this down. August 2011. The markets rally into 2015, 2016. We had another crisis. We'll see that in a moment, and that involved China. But then in 2018, when the markets collapsed in December of 2018, write that down, we had a repo crisis. There was a significant pivot by the central bank, more liquidity added to the system. That led us into COVID, which led us here. And you're going to see this chart in a moment before we had our regional banking crisis and ultimately the gilt crisis that transpired in 2022. The world has changed since 2008 and especially 1993. In 1993, that's where we saw quantitative easing really truly find its beginnings in inflation targeting. And there were 6 things that happened in 93 that have completely led to a lot of the problems that we have in monetary policy and fiscal policy. Back then, we had inflation targeting begin, which is the process of the Federal Reserve trying to ensure that interest rates were at 2% or more to prevent deflation, largely driven by the e-commerce boom in the 1990s. The belief at the time was Americans are too stupid to understand that if all the prices come down of everything, they're going to be upset that even though they're going to be able to get more abundance from deflation, they're going to be upset that their real incomes have dropped and the value of their houses has dropped. And because of that, that can lead to, especially if you're on a 30-year mortgage, that can lead to a debt deflation trap. So let's just print some money. Let's print some money. And we're going to start this process. And that has helped anchor both the dot-com bubble and virtually all of the inflationary moves that we have seen going back to the 1993. We had fiscal policy change. We had supply side change where we put Al Gore in charge of all of the supply side policy in the United States. We let Rubin run the Treasury Department. We let Andrew Cuomo take over at the HUD, joined in 93, takes over in 97. And ultimately what he does is forces Fannie and Freddie to keep pumping money into the system. He brings down Fannie and Freddie. The last thing that happened in 93 was the creation of the passive investing world known as ETFs. And since then, the markets have seen a lot of lack of price discovery, largely because of so much anchoring in passive investing. That is one of the key things. 2008 happens, and then we've been in this QE expansion over the last 15, 16 years. Now, what I'm saying out of this is the Fed rate policy and earnings are overrated when you really think about the liquidity theory and the arguments that are made by Howe. Liquidity theory offers a rational explanation for market spikes and crashes since the GFC. And the capital largely is not driven by creation by the central banks. The shadow banks are responsible for roughly $106 trillion in liquidity today. And that is a big number, right? Well, you're going to see how big it truly is in a moment. But this goes back to a lot of the research and stuff that I was looking at by Zoltan Posner going back to 2008. And this all provides a very good thesis as to why QT efforts did not lead to a 2024 crash. And it has defied the bearish crash calls in this publishing industry. So all the people who say, well, I think the market's going to fall 50, 60, 70% in 2025, they're not following the liquidity cycles in any capacity. In fact, they're ignoring them, and they don't seem to understand the role of both the shadow banks and the central banks and what they actually do in this system. The central banking system's design is to provide support to global liquidity and prevent deflationary crisis globally. And I don't think that Howe has written that directly, but that is what I have inferred from his work over the last few years. This is the chart from Capital Wars. He updates this every week or so, and Howe effectively stating that back in 2011, we were at about $100 trillion in global liquidity. We are at 177 today, including an increase of 9.5 trillion since January 2023. And as you can see, if you look at the MSCI World Index, global equity, and then look at global liquidity as he has described it, you see a monstrous move up in the world index going back to 2011 from roughly 1,300 to where it is at 3,600 today. That is a significant move and a direct causal relationship between these two lines. Now, if we look at 2018, which we're going to discuss in a moment, late 2018 was a bottom in the cycle as laid out by this here, right here, the repo crisis that transpired September through December. And in December of 2018, the S&P 500 fell by a whopping 20% in a month. And then the Fed pivoted. And certainly after the Fed pivoted and provided cuts and started engaging in QE some more, well, the market went a lot higher. In fact, we saw a cycle from 2018 up to the COVID top, a move in global liquidity from about 125 trillion to 170. And yes, there was a major crisis that transpired in 2020, but this is not that complicated. In fact, a comedian 2 years ago laid out exactly what I'm stating in one of the best 5 minutes of comedy that I have seen ever. I am a huge George Carlin fan, and this is up there with Carlin's best of understanding how systems work. And what Mo Amer points out is that when COVID started, everybody couldn't go to work. And he said, well, how am I going to pay my bills? Government, send me money. And the government replies in the joke, well, we're $20 trillion in debt. We don't have any. And then he points out, well, the stock market's crashing. And then they say, well, wait a minute, the stock market's crashing. Pump $3 trillion into the system. And everybody is at home. Everyone is just at home with all this money coming in. And then all of a sudden, the stock market just starts screaming into the sky. And what he effectively notes is, wait a minute, I thought that this was all based on cash flow. I thought that this was all based on numbers. I thought this was based on fundamentals and how the economy was doing. How is the stock market going to all-time highs? Well, they injected trillions and trillions of dollars. They created 30 to 40% of every dollar ever in existence. And as we have heard, which is money moves markets, and Druckenmiller has said it is liquidity that moves markets. 5 minutes of stand-up comedy points that out beautifully. These are the waves that Hal lined up, and this is exactly the same chart as Ainsley Capital. And Howe effectively argues that the bottom of the liquidity cycle most recently transpired in October 2022. That was where we saw a massive downturn start in the wake of Jerome Powell's speech in August of 2022. And we're going to get to how we knew something was wrong at that point. But what I want to point out about this is that we didn't know that period, that was, as they are describing here, the regional banking crisis. There was a lot more to it. There was a gilt crisis in England. The Bank of England effectively had to engage in a soft default. The United States Federal Reserve pivoted on mortgage-backed securities. And not a lot of people seem to know this, but look at the chart from October 2022 to about a year later. Home builder stocks went up about 100%. Largely on the back of that little tiny pivot that transpired. This is important. What's happening in today's liquidity cycle? Well, it's in the book. 6 out of every 7 new dollars is used to refinance existing debt, and only 1 is used to finance new growth. And new liquidity fueled by collateral quality, right? So if bond yields go down, the price of the bonds go up. That is good for collateral quality. And monetary inflation drives equity and risk assets. Once again, money moves markets. And Hal said that the market bottom was in October 2022. The expectation for him is in 2025. I'm anticipating around Q1, Q2 of 2026, because there still is a lot of fiscal stimulus coming into the market next year, both from infrastructure and from the CHIPS Act. And the way that it's laid out, global debt and global liquidity move together. When liquidity is above global debt, you have inflation, right? There's more capital, there's more money chasing fewer goods, right? Because one side of government debt is the balance sheet of the private sector. But when liquidity is below that debt, and there's not enough capital to pay off that debt and finance that debt, that's where these deflationary events transpire, these liquidity events transpire. And we're going to point out how we were just in one about a week and a half ago. We're still in a big picture problem, but there's something that happened this week that is very reminiscent of events that have transpired in recent years. Central banks are responsible for stabilizing the debt systems in the world. The expansion of the private sector balance sheets enabled debt growth. Private credit has led origination in the last 2 years on a massive level, helping the markets move much higher. The wave that Howe has lined up, that we get up here and we start going this way, well, that's where the Federal Reserve is probably going to step in, and some of the central banks globally are going to step in and start engaging in more quantitative easing. And it could be fiscal repression, where they're going to buy the front end of the curve in order to try to reduce the rates and drive up the end of the yield curve. Or it could just be we're going to buy a bunch of mortgage-backed securities. Who knows? There's many different things that they can do, that they can get creative with, just like they did with the discount window in March 2023. So we're expecting rampant levels of monetization by central banks during that next bottom of the cycle. And as Hal lays it out, 5.5 to 6 years. So that would put us around 2022 at a 6-year clip. That puts us somewhere around 2020, late 27, maybe 2028 for that bottom. And that's where the Fed starts monetizing again. And that's where the Fed's balance sheet, which had originally started at $200 billion in 2002, jumped to how many trillion come 2011, then hit as much as $9 trillion recently since the runoff has started. Well, we'll get back above 10 trillion, possibly 12 trillion. Who knows? Yes, QE infinity is going to continue. They are not going to let assets crash. Central banks are deathly afraid of debt deflation spirals, and we have a playbook for all of this. But first, let's get to the second thing. Market momentum. I just cited Hal as my primary influence for understanding the liquidity side. I've cited Ellie Kennedy on the central banking side, and now we get to this. J.D. Henning, he's phenomenal. And he wrote this dissertation back in 2016, and he points to this chart. This chart is what you need to understand in order to avoid a significant crisis in the financial markets. JD lays out that stocks move in 7 different directions. And in those 7 different directions, you want to look at the outliers. So once again, the first part is a negative momentum reversal. That's where the stocks are moving much higher. They're going to their peak. You can look at the RSI, maybe the MFI, they're at their top. Well, now they're going to start to turn negative. And that's where the outflow really begins in the stock. So what he's doing is he's measuring the number of stocks that are in number 2, which is the negative momentum acceleration period. Then you have 3 where things start to control, things start to cool off, and then the stocks slow down, and then we start to turn the other way. This is all outlined in his paper. And then you get to stage 6 where all this money flows in at the same time. And there's lots of stocks breaking out, 5%, 6%, 10%, who knows how many percent in less than a week, maybe 10 days. So he's measuring the stocks that are accelerating down versus the number of stocks that are accelerating up. And then he's just simply doing a math equation. How many are accelerating versus how many are decelerating? And it makes sense because when you have scale at the S&P 500 and you see a company like NVIDIA dropping hundreds of billions of dollars of market cap in a day, that could just be a one-off. But if there's dozens of stocks going down very, very quickly and only a few going up, money is leaving the market, everybody. So if you have a positive and negative screen for this, which is basically his thesis, then you have positive acceleration, then money's moving into the market. Get with it. Get on board. You're going to start to see ETFs bidding back up. You're going to start to see capital rotation. If things are yellow, well, that's a hedge period. If things are red, start to get out, move to cash, really hedge. And when you see nothing accelerating to the downside and everything is positive, well, that's a market top. And when everything is really negative and no one's buying anything, that's when you should be buying everything. That is a liquidity bottom. That is so much money coming out of the equity markets that central banks do step in. Now, we have done a lot of analysis of this. I've read his work. I've looked at this very deeply. And if you understand the outliers and you understand how to analyze it, you're not going to do it as perfectly as he might, and you have to kind of build your own system. We built back on this, kind of focusing on MACD and ADX rate of change to really try to understand capital coming out through the S&P 500 and the Russell at the exact same time. And then we moved it over to the NASDAQ as well to try to get a real true understanding. And using just data from FinViz and bar chart, there's some replication here. And we've started to include Henning and then his father's work and William O'Neill and Joel Greenblatt and Pham and French. And you just want to have a signal that's positive or negative. And you just tell the markets, you just tell everybody, hey, we have this signal. We look at this signal every day. And then we look at liquidity and then we compare it with insider buying, which I'm going to lay out in a moment, and you end up with this. This is the positive and negative signals that have come. And if you can utilize RSI and MFI and MACD and ADX to kind of replicate this, or you can do the measurements of stocks, or you can just simply look at a specific measurement that exists. And virtually every hedge fund that I know has some reading of this in some capacity. But what you're going to see here is that the tops, before things really start to sell off, it's never right at the top. It's usually a little bit of outflow. There's a couple of days of selling. Then there's a pop. And then the market completely gives. Now, you're going to look at this chart and you're going to say, okay, he's just picking tops and picking bottoms. No, I'm not. In fact, let's start right here. This is June 8th of 2022. Signal turns negative. And we had a monstrous sell-off for 9 days. We didn't know why. But the largest hedge fund sell-off in 15 years had just started. Now, how about this? Signal that Tim and I had focused on. We were on air talking about it. We were looking at the MACD. We were looking at the ADX. We were measuring stocks, just looking at the number of stocks that are up in 10 days, 10%, and the number of stocks that are down 10% in 10 days. And then just saying plus minus, and then looking at MACD, RSI, MFI, and getting a sense of this. We go negative on March 7th of 2023. Okay, March 7th, right here. This is what I'm trying to really point out about what there is a capacity for market timing. What happens on March 7th is you have a massive rush of capital out of the market, and no one knows what's going on. There's some people looking and saying, oh, this has to do with the jobs report that just came out from February of 2023. 9 days later, was the Silicon Valley banking crisis. Actually, 4 days later. If you go to Google News and you set a cap up to March 7th, 2023, and go back a year and a half and type in regional bank crisis, regional bank liquidity problems, regional bank problems, anything, there is no mention of any regional banking crisis or concerns about Silicon Valley Bank, except for one blogger that I found who wrote about this in October of 2022 during the gilt crisis and warned about it on Seeking Alpha. I have not seen any mainstream media ever suggest before March 10th of 2023 that there may be issues within the regional banking system. Now, why else would we pay attention to this? Well, this is the big one, because this just happened. It happened about 3 weeks ago? No, a month ago. Forgive me. Right here. There was a sell-off. So money is moving out of the market. People know something's wrong, just like in March 7th, 2024. There was money leaving the market. And then the crisis happens a week later. So people are running ahead of this. Well, this is July 31st, when this first started to show yellow and then went negative in the morning on August 1st. What happened on August 1st? What happened on August 2nd? We don't know. We do know what happened on August 5th. It was the largest sell-off in the Nikkei since 1987. And every single one of these events that have transpired on your screen, this has gone negative first. And we don't know what is happening in the market until we find out about a week and a half later on CNBC. The bond crisis in October 2023, signal goes negative the first week of September. The gilt crisis in 2022, signal goes negative in late August when Powell spoke at Jackson Hole. Go back to the April sell-off. This was well telegraphed that there was going to be some problems in the banking system because of so much movement in the market from the backside of 2023 up into April. There was a lot of money in the money markets. Well, a lot of global private credit hedge funds use the money markets for origination of all that liquidity that we've talked about. Well, now the money markets are drawing down because people were paying taxes. And then you had a relatively sizable sell-off in April. And then on the backside of the tax day, What happened? Janet Yellen got involved. They started using the Treasury General account. They started to stimulate the economy and get confidence up again. And the market takes off right on the backside of options expiration in April. Now, there's a stock that is very tied to all of this, and you're going to be really blown away by the fact that once we pull all of this together, you're only going to want to trade this one particular stock because it absolutely takes off every single time that there is a crisis averted, largely by central banks and largely by an expansion in global liquidity. And my argument to Henning is that it's not about drawdowns. It's really what multivariate analysis and ultimately the ability to time markets on the downside, particularly in negative reversal events, it has to do with liquidity in the global markets and on a rush to cash and whatever that event is. And I believe that if you go back and you look at the work that Henning did when we started to really start to experiment with this in 2019, we had a negative event transpire somewhere around February 21st, February 20th in 2020. And it was the first time that I had really figured it out. And I remember just saying, wait a minute, something's really off. And then you had March 2020. And this signal doesn't go positive until around April 14th of that year. So once again, if you have events where central banks are pivoting, October 2022, perfect example. Here is April 2023, the regional banking crisis. What is that positive turn here? That is the Federal Reserve opening the discount window for the regional banks. What is this here? Well, this is the bond crisis that we witnessed in late 2023. And then we saw a lot of stimulus come on board on the backside. This market moved rips higher. This is the short-term tax crisis. Here is the TGA involvement. Here is the event that just recently transpired with the Nikkei. And then we're going to talk about this because my general view is that sell-off that we just saw from here to here, this is the Mag 7, is tied to China and tied to the debt deflation issues happening in China. And what has transpired in the last week? The Mag 7 just had its best 5-day winning streak since March 2023. What happened in March 2023? Regional banking crisis. What happened in March 2023? The Fed pivots and opens the discount window to the regional banks. More capital, more liquidity in the system. Mag 7 takes off. Something happened in the last week, and it could be that China has operated in coordination to provide support. We saw some repo activity from China. We saw the Financial Times come out and say we need to add $1.4 trillion in money pumping People's Bank of China. Think something's happening? Think that there might be something like in 2016 when the S&P 500 fell 20% in late 2015 because of a debt deflation crisis that transpired in China. And then they had the Shanghai Accord. And all the banks got together and they pumped and they figured things out. And then the S&P 500 from around January 2016 just takes off the rest of the year. Central banks engaged in coordination, just like they did in late 2022 in October during the gilt crisis. Something happened this week. Something backstopped this week. Now, it doesn't mean that the worst is over, but it means that there's got to be some level of coordination happening. And we can't just use technical analysis and say overbought, oversold. Something happened because gold is backing it up. Gold has now moved from the liquidity bottom in October 2022. It was 1,600. It is now at $2,600. That is not because everybody wants gold and central banks are buying a lot of gold. A lot of this has to do with broad expansion in liquidity, $9.5 trillion added. You have the demand side from the central banks, absolutely. But this is a monetary inflation issue. And when you see on the backside of 2022, gold go up $1,000, one of the biggest moves we've ever seen in history, we cannot just sit here and say, oh, well, it's just that people are worried about a recession. Let me tell you something. When there are liquidity events, big liquidity events, gold doesn't do great. Gold doesn't go through the roof. No, it's like any other asset, and it's one that benefits from this constant state of monetary expansion globally. Which brings us to the third thing, the market bottoms, the perfect market timing. The thing that you need to be watching every single day like it is Christmas. This is the third chart I look at every day. This is on SEC Form 4. It's $50 a month. And this is the insider buying dollar for dollar to selling amount. This is every dollar that executives at their own company buy their stock with their own money versus how much money they are getting by selling their stock. And what's very important to remember is that a lot of technology executives are paid in their own stock. So they sell the stock, and that counts as insider selling. But it's when they are all buying, that's what we're focusing on. And if we look right here, we look at the last year, look how strong on the aggregate in the last year insider buying was in late October. Well, that was the bottom of the 2023 bond spike to 5%. Everybody comes in and says, okay, it's overdone. And there is effectively a lot of focus on Treasury and Fed policy that's going on at that period. The market bottoms out about a week later. You look at the red line, that's the S&P 500. Look how much buying there was from executives. Blue line, which is the 5-day moving average. And look how the market takes off. High insider buying signals typically align with short-term bottoms, and low buying signals align with either short-term tops, earnings season blackouts, or just a lack of interest. What was the last major event that transpired in the last month and a half? This is the Nikkei crisis. Look at the spike in insider buying. And then remember, central banking activity done by the Bank of Japan. The Bank of Japan says, we're not going to raise rates until the market can handle it. Well, bad news. The market's never going to really be able to handle a dramatic reversal of decades of monetary malfeasance. But you see that spike transpired, and you see it's not a big move, but it's enough to signal, hey, money's coming in and executives are bullish about whatever is coming down the line. This is the most important chart in finance, all of finance. It's this. This is insider buying to selling, blue line, 5-day moving average dating back to 2006. Look at where it is strongest. March 2009, that is the beginning of QE1 by the Federal Reserve. That is where the Fed started Operation Twist and where they started injecting capital directly into the market. And everybody bought. The previous spike, which is right here, that's right after Lehman. That's all of the executives saying they got to step in now. They got to step in and do something now. Everybody knew. And it took a couple of months of coordination. They had a vote that failed. They weren't able to get direct injection. The $787 billion stimulus, whatever the hell that thing was just a pork lateral nonsense. Didn't do anything to direct and address credit and liquidity in the global system. So the insider buying really came at that market bottom right here. That's March 2009. This is the 2011. This is the ECB crisis, the European bank crisis, and the Treasury debt ceiling crisis. Very, very strong when the ECB started getting involved. And that started to bring us to the onset of 2012. We started to see more and more central bank activity. This is the Shanghai Accord, 2015. This is where China crashes out. We see a 20% drop in the S&P 500. And then the Shanghai Accord. And it's funny because in like March of 2016, Reuters and a couple other media outlets come out and say, well, wait a minute, was there some central bank event that we don't know about that, everybody got together? It sure seems like it. There's no real confirmation. But sure enough, that was the market bottom. And sure enough, there was coordination. And sure enough, all of the executives were buying their stock at the strongest level that we have witnessed in the S&P 500 going back to the Lehman and the 2009 financial crisis. 2018, two single periods. This is September and December of that year. S&P 500 fell roughly 20%, I believe, in late 2018. Two significant moves in insider buying at that time, calling the bottom, huge pivot by the Federal Reserve that transpired. We saw them effectively start adding back to the balance sheet, cutting their interest rates back from 2.5%. Well, market rallies. You don't need me to tell you anything about COVID. They dropped trillions of dollars from the sky. And effectively what happened is you had the Bill Ackman Hell is Coming statement. I believe that bottom was March 25th, 2020. And then you had Neil Kashkari, Federal Reserve president from Minneapolis, go into 60 Minutes and effectively say, we got unlimited money, bud. We're just going to hit a number on the computer and we're going to start jacking this thing up. And that's where the insider buying really kicks up, final week of March. And then all this capital starts flushing back in. We get a positive signal about 2 weeks later, resultantly, and this thing's off to the races. The one false move that we saw was the beginning of January 2022, because everybody thought and believed, pal, that we only needed a 25 basis point hike in terms of managing inflationary expectations. Obviously, that was very, very wrong. But just because they're wrong the first time, the insiders, doesn't mean they're going to be incorrect the next time. This is a very strong period of insider buying that transpired from June to October of 2022. And as you can see, we had the market liquidity bottom here as Howe has defined it. And we've been off to the races. Strong insider buying in October of 2023 and a couple of spikes here. This is that 2024 tax period right there. So once again, insiders are calling the market bottom in every major short-term liquidity crisis. 09, 11, 16, the bond spasm in 18, COVID, the gilt crisis, the banking crisis, and that yield surge in 2023. And each event has accompanied a major shift in fiscal and monetary policy. It has recharged global liquidity, and it has moved equity prices higher. And all of these down cycles, as this thing moves lower and lower, we have seen time and time again, and this goes back to Grant Henning's book, the most featured oversold on the relative strength index and the money flow index, right? So it is down around 30 on the money flow index. And forgive me, I'm looking at the MACD right here. But if we look at the RSI getting into oversold, and then you start to see the MACD turning positive, we now have these kind of short-term pops. We're not going down in straight lines. We're seeing major sell-offs. And then what transpires when things get into oversold, as Stanley Druckenmiller pointed out in 2018, that the algorithms start to buy when things get into the third standard deviation during oversold periods. Then they start buying everything up and squeezing, and people who are short are now in trouble, and everybody's trying to follow the algorithms. Well, they're all kind of coded to do this, to buy in these short-term periods, and then they suck everybody back in, and then sure enough, keep in mind, the purpose of a market is to sell. Druckenmiller pointed this trend out in 2018. They buy in the third standard deviation of oversold. So recent examples of this major market reversion that has transpired, where things get oversold, people panic, they don't know what's going on, and there's some sort of central bank or policy shift that transpires. October 2022, during the British gilt crisis, there was a Fed MBS pivot. There was a Bank of England pivot. March 2023, you had a regional banking crisis. The Fed provides liquidity support to the regional banks. Market reverts out of oversold. October 2023, yield surge. Yellen responds. 2024, money market tax sell-off. Treasury comes back off the top rope with the TGA. And then the most recent event, that's the Nikkei event that transpired on August 5th. Bank of Japan comes out and says, oh yeah, maybe we're not going to do this. Well, we moved to oversold real quickly on the daily charts. And then they say, oh, everything's calm. And then the market just reverts. And everybody's sitting here going, what the hell's going on? Well, a statement does that. A statement does that. And the buying is not necessarily coming from funds all of a sudden. It might just be coming from algos. But during that most recent period, that Bank of Japan period, where we had that huge sell-off, retail investors, I believe, sold about $1 billion in stock. The institutions bought $10 billion. So as I'm telling you, this is a rigged game, and you have to know how to pull the card at any given moment. So as I said, let's go back to the concept of challenging narratives. Do valuations matter? Well, not really, because PE ratio hasn't really mattered in the last decade and a half. PE ratios are overrated, especially if companies are using their cash flow to buy more to reinvest into their business. Amazon's the poster child of this. NVIDIA has been the poster child of this. Does information lead to better decision making? Not if you have a worldview, not if you, once you see what I've just laid out, that this is the way the world works. So I don't need to sit here and spend countless hours looking at underlying fundamentals of certain companies. I can know what are these value drivers that work. Are markets so random that market timing is impossible? No. Henning laid this out. How's laid this out. I'm laying this out. Insider buyers are laying this out. The evidence is clear on these three things. Are markets efficient? Absolutely not. They are irrational. People are irrational. Even the algos are irrational. We are all tied to the way that this underlying system works. Do earnings and rate policy really drive markets? No. Liquidity drives markets. Stanley Druckenmiller. Money moves markets. Solomon Brothers. So let's talk about this thesis. What do you own? What do you want to buy? Well, first off, buy everything that's not nailed down with fiat currency and then nail it down. Make sure you do that. But within this kind of concept of monetary inflation and liquidity expansion, or mile, you got to be patient. You got to know, all right, is there an event transpiring? And if that is true, you're red and you're green. And if you're green, then you start to buy the assets. And here you have something very simple. Gold's a perfect example of this. You're seeing the central banks engage in this. But look at metals. If China is about to pump a significant amount of money, and we looked at what just transpired in recent days, copper prices moved back above 4. Well, if the People's Bank of China is pumping, it's no coincidence that copper prices move higher, because this is an economy that is driven heavily by manufacturing. In the United States, we are a financialized economy. So every time that we pump, it's pretty good for regional banks. It's very good for Jamie Dimon. Energy and electricity and midstream. I don't care who you are and where you are. If you're not investing in electricity in the midstream, you're out of your mind, because electricity prices are only going to move higher. And that is going to be a result of the commodities that are linked to the electrification of our grid and auto supply chain and everything that comes with it. Midstream energy is going to be in constant demand, particularly natural gas, but even the elements that include methane gas, where they're putting these AI data centers in the middle of the energy deserts. Blue chip stocks with high F scores and buybacks. Tim and I talk a lot about Piotrowski F score. That was created by Joseph Piotrowski back in 2002. He created this poor man's momentum system where you get a score. It's a quality score based on, are you improving your capital efficiency? Are you buying back stock? Are you paying down debt? Are you increasing your dividend? And all of these things, these 9 things, every one of them that you are doing, you get a point. Well, if you have a high F score, you're very capital efficient. You're buying back your stock. You're paying down your debt. If you look at the stocks that are really on fire right now that have these 9 scores, it's no coincidence that it's a lot of very high-end blue chip S&P companies. And these are the companies that are going to be able to absorb all of that monetary inflation that comes down the pipeline. All of that monetary expansion, this money just moves through their balance sheets. A lot of these companies have excessive market share, and in some cases, they're either duopolies, oligopolies, or just straight up monopolies. Prime real estate, they're not going to make any more of it. So once again, Class A REITs, pay attention to Brad Thomas at Seeking Alpha and at Wide Moat. You want to have some exposure to Bitcoin, but we have seen that, during these periods, these winters, that has kind of been in relationship where when Howe has said that the liquidity cycle is moving negative. I would argue that because of that winter is coming in 2026, 2027, and you're probably going to see a significant downturn in a lot of these assets, particularly non-Bitcoin related, 26, 27. And then when we get to the backside of this in like 28, 29, and we start to see an expansion in the cycle once again, that is probably going to be the period of time where there is going to be a relationship between the advancement of the decentralized and the DeFi movement. It's finally going to come to fruition. And that is where the real opportunity is going to exist in the next decade for the altcoins and everything else in the Ethereum system. It's going to take a couple of years, but when that money comes back, it's going to come back just furiously. And then there's that last thing, right? What was that magical market timing stock that I promised you, right? And I said, we're going to draw from the bottom of the deck and we're going to pull an insurance company out of it. What company benefits the most from an excessive expansion in liquidity, which lowers default risk in the global financial system? What is the company that benefits immensely from excessive expansion of liquidity, lowering default risk globally because there's more capital in the system all at once? And I want you to keep this in mind. It is the company that was the 3rd largest bailout in U.S. history. The answer is simple. That company is, drumroll, AIG. We saw a lineup of significant insider buying, and we saw a lineup of these negative momentum, negative outflow, negative downdraw, liquidity crises events. All of them are right here. This is the ECB crisis, and once again, the Treasury crisis, concerns around the debt ceiling. This is the China crisis, Shanghai Accord. AIG goes from 49 up to about 65 in a year once there was that pivot. This is the Federal Reserve moving and engaging in QE4. The stock hits that bottom in late 2018. Concerns around global default risk, 40 up to about 60 in less than 6 months, 40, 50% move. This is obviously the biggest financial crisis that we'd witnessed since 2008. This is just COVID, right? This thing hits, I believe, $20. And then once all of that capital comes into the market, as that comedian says, why is it going up? Wait, I thought businesses were going out of business. Nobody's home. Nobody's doing anything. Why is the market going up? Why is this expansion going up? AIG went from 20 to 65 in 2 years and then hits the top of that cycle. This is the gilt crisis, pivot. This is the regional banking crisis, pivot. Move from 50 to about 80. And then let's look at the most recent 2 events that transpired this year. Tax season sell-off, and then we saw that kind of that move by the TGA and by Yellen, and the expansion and stability that happened. Stock goes from about 72 up to about 80 in about a month. 10% move. You can do a lot with options on that. And this is Nikkei. We went from 80 to 70 in about 3.5 days. And then Central Bank of Japan says, we're not going to do anything, man. This went from 67 to 77 in a month. And it makes perfect sense, right? Because there is a total reduction in liquidity risk. There is a total reduction in default risk when you pivot and you provide support to the global system. Remember, the system is designed to reach these outcomes. When they provide that support, these are the outcomes. The outcome here is a 10% move in a month. The outcome here, by a massive amount of liquidity and monetary expansion support, was a move from 20 to 65 in 2 years. That is the outcome that it is designed to do, because AIG once insured, as Hank Paulson once said, half of the Western Hemisphere's credit default swaps. So once again, the system is designed to perpetually provide support to the global liquidity system. The central banks doing that on behalf and watching what's happening in the global shadow banking system. Shadow banks 107, 108 trillion. Global liquidity is measured by how? 179. Central banks aren't as big as where this private origination is. Now that's AIG. So I'm telling you, when you are watching blood in the streets and you are watching people freaking out and you're watching AIG fall, the insiders start buying these periods here. You start to hear a little bit of chatter about the central banks getting involved. You also start to see the markets kind of bottoming out, RSI 30, MFI 20 at the same time simultaneously. And they're going to pivot, buy AIG. Just buy the stupid thing, because once again, it benefits when all of these conditions align. And what else is correlated to AIG? Insurance companies. So look at MetLife and look at Genworth, and you're going to see a lot of those bottoms, very similar relationship. Student loan services, Navient, NAVI, which just had that whole settlement. This thing, once again, concerns about whether or not people are going to be able to pay off their student loans. Sallie Mae, same thing. Leveraged mortgage REITs, Annaly. I remember Tim was recommending Annaly, I believe it was like March of 2013. And everybody's going, wait a minute, I thought that this is kind of a disaster happening in the markets. He's like, just buy the thing. And then certainly we get this effort by the Fed in March 2023. And NLY has just been a dream for a lot of people in the last year and a half. What is it at right now? It hit in October 2023. It was at 1470. So that is the bond crisis. It's back at 2045 with a 12.7% dividend. New residential, same thing. Leveraged asset managers. Look at Blackstone, look at Apollo, and the regional banks. You got a regional banking crisis, and the central bank starts to open up its discount window. Zion was one of the survivors, right? One of the big survivors that transpired in 2023. Keep in mind, this stock was down in the crisis of 2023, down to about 22.43. It's back up at 46. 3.6% dividend. And in the last year, it's up 26%. Well, it's done very well since that bottom in October of 2023 when bonds hit 5%. So this is my conclusion for you. Every system is perfectly designed to get the results it gets. This system is designed where the central banks engage in ample amounts of liquidity support to the global system itself. The world financial system is designed for perpetual bailouts. They are not going to let asset prices crash. Now, you may want to trade this until it breaks. And you might think, wait a minute, what if you're wrong that one time? This is how it has been since 1970, and we went on the fiat system. This is how it has worked. Now, if we start to see a collapse in that system, well, you're going to have bigger problems than whether or not your AIG stock that you bought is down another 10%. There's going to be other things that you're going to need to know. You're going to want to take at least some sort of farming class and learn how to make bread in an outdoor stove. Don't worry about that. Until then, trade it until it breaks. Massive insider buying tends to reflect market bottoms in these crises and accompanies major policy shifts, both at the fiscal and monetary level, that offer a boost to liquidity. The equity strength signals, what we do, what we talk about, you can look at what Henning does, however you want to do it. You want to go run a hedge fund and you figure out a different way to do it. You want to follow my friend at Cantor Fitzgerald who trades volatility and has a phenomenal eye for what's going on in volatility. It's all the same thing. It's money coming in and money coming out, and no matter how you measure it, it doesn't matter which way you measure it. What matters is that it works. And if you see that oversold of RSI and MFI, and then you see what Henning had pointed out, where you just have no acceleration, no significant buying, well, that might likely be the bottom, or maybe it gets a little bit worse. But the moment that you see, well, the Federal Reserve is going to start to engage in quantitative easing, buy everything that isn't nailed down, especially AIG, which benefits from a reduction in liquidity risk and this kind of policy bailouts. Here in the Republic, we say this with every sign-off that we can. Stay positive. And it means one of two things. It means, well, hopefully money coming into the market remains. We are going to stay positive in terms of how we view equity strength or how we view liquidity flushing into the system. We want it to be positive. But when it's negative, we want to actually enjoy our lives. And if we are prepared for that, and we focus on this, and we follow this worldview, which we do on the Republic Risk Letter that we write, and we do in virtually how we do everything else when we're trading insiders, or we're selling put spreads, or we're buying something where a lot of insiders are buying at the same time, we don't freak out when there are these negative events. We just don't, because it is that behavior of the markets, it is the behavior of the participants that leads people to make mistakes. I can't tell you how many people in the last few years that I've met, they'll sell everything off and then they'll say, wait a minute, why did the market move higher? And I try to explain it, and I just explained it to you. I just explained to you that money moves markets. Now, when it flushes out, we don't know why it's happening in real time. CNBC will tell you, well, it's because NVIDIA did X, Y, and Z. Is it? Do you really think that the market really rebounded this week because the CEO of NVIDIA said our demand is strong and we can't fail, like he is some member of a Disney family that just, they've got to carry the weight of the world on their shoulders? No, something happened this week. Some level of support happened this week, and it's very apparent, and we're probably not going to know what it is for another week and a half. And there's going to be a lot of instability in the near future. We have trillions of dollars that needs to be refinanced in the market. I said, what's going to be the next thing that causes a sell-off? You got $2.5 trillion just in CD deposits that need to be refinanced. You have another $9 trillion that needs to be refinanced by the Treasury Department. You have a debt deflation situation going on in China. You have the still lurking issue with the Nikkei, and then you have deindustrialization across Europe because nobody seems to understand that the entire German economy was $2 trillion of GDP leveraged on about $20 billion of Russian natural gas? What did you think was going to happen? My point to you out of all of this, out of this today, I wanted to set the record and I wanted to say to you, listen, this is my worldview shaped by a decade and a half of work, a lot of reading, a lot of puzzle pieces that have been put together over time. And I haven't been right the entire time along the way. And I've obviously made mistakes when it comes to trading, but I've been more right than I've been more wrong. But I get these moments every 6 months, sometimes 3 times a year, usually 2, maybe just 1, where we get a big reversal event. And that is going to allow us to move a lot of cash back into the market. I don't like to short. I don't like to buy leverage. I don't like to try to time things to the downside, because if 2020 taught us anything, going into the weekend short was a dangerous proposition because central banks can engage in weekend meetings. They did it a lot when they engaged in some new levels of quantitative ease in QE4 in March 2020. It is a dangerous game. And the real key thing that you can think of is that when we have these events, it's time to start building cash. It's time to remember that cash is a position. And when there are these events, it's a lot of people looking to build cash all at the same time, because they're going to have to pay off debt. They're going to have to roll things over. They're going to have to refinance. And a lot of this is obviously done globally in the US dollar. Now, I am not a believer that the BRICS is going to overtake the US dollar anytime soon. I don't believe that there's going to be any significant trade crisis in any time soon. I still remain very diligent in terms of trying to stay on top of things just in case things shift. But I do just want to point this out. This is my view. September 15th, 2024. And I did it today because this is a very important day in my life. First off, this was the same date that I met my wife 13 years ago. And it is also the same date as Lehman Brothers collapsing. I remember walking up State Street in Chicago the day that it happened. I left New York in March 2008, a couple of weeks before Bear collapsed. And I thought the world was really, truly ending back then. I didn't really understand at the time that central banks could really get involved in how the monetary system actually operated. And I remember walking up State Street in Chicago and people were coming out of their buildings 10:30, 11 in the morning. And they had bottles of booze. And I just looked around and I could not understand at that moment what was happening in time. I just thought to myself, well, there's a housing crisis. Okay, I've seen this before. But this was unique. And then when you learn about AIG's bailouts, and then you learn about how much leverage there was in the system, ultimately what you come to find out was that that date, September 15th, 2008, that was the day that capitalism died. And since then, we have been on this massive level of life support, this constant rhythm of pops and drops and bailouts and everything that comes with it. Now, you can go back to 1971, you can go back to 1993 as pivotal years when this kind of monetary system really evolved, but it was 2008, this date, that really set. This is why housing prices have recovered the way that they have. It all starts at the front of the curve. So anyone who's sitting here blaming grocery stores for high prices and inflation on lack of supply, these are the people who are actually in public policy, and they don't understand the impact of their policies. It's very easy to blame high prices and CEO pay and all these other things on greed, but that is so far down the monetary supply chain that you have to go back and you have to listen to what Friedman said. Inflation is and always will be a monetary phenomenon. And it has been a monetary phenomenon caused by central bank activity and fiscal stimulus. And at the end of the day, if you really want to know how and why things have gotten the way that they have, especially in recent years, it's because they printed too much damn money. This is not that complicated. And some people are going to look and they're going to say, wait a minute, well, the money supply has gone down, right? The M2's gone down. Not global liquidity, not the way that Hal defines it. The way that he defines it is that's where the M1 ends, and then it's everything else. And I encourage you to read this book, and I encourage you to read Grant Henning's dissertation, and I encourage you to follow what the insiders are doing, and I encourage you to follow us at Postcards. This is my worldview, and I will protect it. And if you see anybody else ripping it off, or you see anybody else running a promotion about it, you let me know. I'd like to have a conversation with them. I hope that you enjoyed this presentation. And once again, I am here to work. I am not far from New York. I am not far from DC, and I am not sitting on the sideline anymore. You will see me on camera a lot more here at Republic, and I do hope that my publishing team and my publishing partners will take this seriously. And I do hope that anyone else who is interested in being involved in this journey and learning really how the markets work and utilizing a lot of different tools and a lot of different strategies to take advantage of how this system works. Call me, send me an email. I hope that everybody has a wonderful Sunday evening. I look forward to more conversations with you in the future. Take care and stay positive.